This is what the central bankers have planned next. And this is what you need to be preparing for it. Now, it should be no surprise to you by now that our world is controlled by money, by the central bankers. We have some control over our immediate life, but the central bankers have the control, the booms and busts. And so we need to look at things from an economic standpoint, but we also have to look at things from a political standpoint, and we really need to be understanding what the central bankers' policies are doing, what they're looking at, so we can anticipate what their next move will be, so we know what to do in response to that. So in this video, I'm going to break down the situation that we're in right now. We're going to look at what the central bankers' response has been in similar situations. We're going to look at papers they put out in the bank just a few years ago that explained to us what they're going to do. We're going to look at what types of assets did good and bad in those types of environments, so you have a game plan on how to succeed, knowing what they're going to do and what you should be doing about it. So let's go. All right, welcome back to the channel. My name is Mark Moss, and I make these videos to change the way you think about money, because almost everything you've learned is wrong. Almost everything they're telling you is wrong. Even though they're trying to somewhat tell you what they're going to do, it's hard to understand. So I'm going to break it down and show you the situation that we're in, what options they have, and of course what that means for us. Now real quick, I'm going to make a couple videos on this because it's a lot deeper than I can get into in just a short period of time. And I'm going to be another live event. I do them about once every other month or so, where I can go really deep into a specific topic, show you exactly what I'm doing with my own portfolio, and then I go into live Q&A so you can ask me anything. Take advantage of it. I don't do these very often. There's a link down below if you want to join me. Come hang out live. We're going to dive in really, really deep. I'll show you what I think as my base case is going to happen and what I'm doing about it. Okay, check out that link down below. All right, so are governments bankrupt? What do you think? Yeah, I think you probably already know the answer to that. We'll put a big yes. So the problem with governments is that the governments can't produce anything. The governments cannot give something they have not taken. All governments can do is redistribute. Now they can spend, they can waste, they can do a lot of that, but they can't produce anything. So that's a problem that they have. Now they can take on massive amounts of debt, which drags down economies. We'll talk about that. All right, now what we can also see is there's something called the Keynesian multiplier. And so what this means is that per Keynesian economics, they believe that the governments should just print money, go into debt, printing money, stimulating the economy to get artificial growth. So for example, they want to prevent all types of booms and busts, which is ridiculous because we have seasons and we're humans and we're irrational and we like one thing and then we like something different. Our wants, needs, desires, they change. Also, we overinvest, we overbuild, and then we have seasons, okay, because of that. But per Keynesian multiplier, what they want is they want to level this out. So let's say that we lose right here some economic growth. Let's say we lose $1 worth of economic growth. What they'd want to do is they'd want to take on 50 cents of debt to hopefully get the dollar's growth back out of it. That's Keynesian multiplier, the way they do that. The problem with this is another law, the law of diminishing returns. Now we can break down this Keynesian multiplier here. I believe this is from Investopedia. It's a theory. It's a theory, not a very good one. A theory that states the economy will flourish the more the government spends. But remember, what was the first point we talked about? The government cannot produce something it cannot give, something it has not taken. So the more the government spends, where did they get the money to spend? Oh, that's right, they took it from you. Okay, so that's the first problem with that theory. The next part is the net effect, hopefully, is greater than the dollar amount spent by the governments. They hope to spend 50 cents and get that dollar's worth of growth out of that. We're going to break that down a little bit more for you. Now, I like this part down here, this part, if taken further, if people didn't save anything, the economy would be an unstoppable engine. The economy would always be amazing if you would just never save any money. That's the whole problem. you're saving too much money, and the whole thing is breaking down. That's how insane these people are. So Keynesian economists wanted to tax savings to what? To encourage people to spend more money. Now, if they know anything about human nature, you don't have to incentivize anybody to spend money. We always want to spend money. We always want the new thing, the hot thing. We want to go on vacations. We want to go out to dinner. We want new clothes. Like, we don't have a problem spending. You don't need to encourage anyone to spend, but that's what they think. They have to tax our savings. Otherwise, the whole world will fall apart if we save money. How dare we have a cushion to fall back on, right? Okay, savings as a drain on the economy. So savings are the drain. That's the whole problem. Again, it would be an unstoppable engine if we would always just keep spending. Savings, so this is the problem, is that savings are technically investing, right? Savings are investing. You're not going to the bank and getting cash out and putting it under your mattress. That's not what you're doing. It's either by an individual or by the bank holding the capital. So your savings are typically in your 401k, your mutual funds. Those are in stocks. You have some gold, you have some real estate, etc. So your savings are already invested. So this whole theory is completely off. You can see that. Hopefully that makes sense. All right. But the problem that the government's in always boils down to math. Now, in today's day and age, there's no such thing as truth anymore, and they would have you believe that 2 + 2 = 5. They'd have you believe that they don't know the definition of a recession anymore. They'd have you believe all these things. Doesn't really matter. 2 + 2 will never be 5. Doesn't matter how many times they tell you this, 2 + 2 will always be 4. It's just math. So we have the Keynesian multiplier we talked about, but there's a problem with it. There's a fault. And so what is that? Let's pull that up. So Reinhardt and Rogoff's research reveals that a 90% debt to GDP ratio, so when you've built up 90% debt to your GDP ratio, it says that physicists call that a critical threshold. So once you get over 90% debt to GDP, you can't grow your way out of it anymore. I'll break that down. The first effects is the Keynesian multiplier falls below 1. So now we're not getting enough growth for the amount of money that we're spending. But the problem is that society is addicted to debt, and the addiction consumes the addict, of course, as always. And the problem is here. The national debt is about $30 trillion. The problem is that maybe the $30 trillion worth of debt wouldn't be that big of a deal if we had a $50 or a $60 trillion economy. If you made $100,000 and you had a year and you had $50,000 worth of debt, it wouldn't be that big of a deal. But the problem is that's not the situation we have. We don't have a $50 trillion economy. We have about a $21 trillion economy. So the end point is a rapid collapse of confidence in the U.S. debt and the U.S. dollar. So the Keynesian multiplier works in reverse. Now, we've seen another report here by Hirschman Capital that states since 1800, 51 out of 52 countries with a debt to GDP level of 130% have defaulted. That's it. 51 out of 52 have defaulted. The other one that hasn't defaulted yet is Japan. And it's looking like it may happen very, very soon. So we'll hold out on that right now. They've defaulted either through restructuring, devaluation, high inflation, or outright default. 4 ways. 4 ways out of this debt trap, except today I'm going to talk about one additional way, a 5th way that hasn't been talked about. We're going to show you the game plan for that. So 13 countries right now today are over the 130% debt to GDP. You can see them all right here. Sudan, Japan, Cape Verde, Italy, I'm not gonna name them all, Greece, etc. So 13 countries today have over that threshold. And here's the math, all right? 2 + 2 = 4, not 5. We have about $300 trillion of global debt. If we add up all the debt in the world, about $300 trillion. If we add up all the income or the debt or the GDP of the world, we have about $75 trillion. 75 GDP, $300 trillion of debt. The problem is that, let's say that on that $300 trillion of debt, there's interest that's owed, of course, right? So let's say that it's about a 3% income rate. Interest rate, 3%, which is very low. We can make an equation to gauge how quickly GDP has to grow to keep up with the growing 4-to-1 debt to GDP ratio. So how fast does the GDP have to grow in order to ever be able to grow our way out of debt? Well, what we can see is with a 3% coupon rate or interest rate on the 300 trillion debt, GDP has to grow at 12% annually. So GDP must grow 12% annually just to get out of this debt situation. Now, do you think that's likely? Well, I can tell you in the United States, the last 2 quarters, so the first half of this year, we haven't had 12% growth. As a matter of fact, we've had negative growth. Negative. So we're not anywhere near that. And how does that look historically? Well, let's take a look at that. So we can see here global GDP growth in a historical perspective. So we can go all the way back to the 1800s, 1870 right here, and all the way to current 2021. And what we can see here, the top bar right here is 8%. So we saw 8% GDP growth one time, 1951. We've never had 8% again. We're maybe around 6% right here. And obviously now today we're at negative. We're at negative growth. So historically, looking back through since 1860, we've only hit 8% one time. How do we get to the 12%? The answer is we don't. All right. So if we can't grow our way out of it, then what comes next? That's what we're going to take a look at. All right. Now, there's only 5 ways out of this. Like I said, there's really 4, but today I'm going to present to you a 5th option for how we get out of it. Now, the 4 ways that most people know, I've talked about this in several videos before, so if you watch my videos, you might know this. The first way that you can get out, first of the 4 known ways, is austerity. So austerity means that you cut back on your spending and you live on a budget. First of all, do you think any government is ever going to be able to do that? The answer is no, of course not. Second of all, the people that live inside that government hate it because now all their social programs, all their welfare programs go away. And this leads to massive people protesting in the street. Here's a picture of people showing you exactly what they think about austerity. They don't like it. They don't like it when their programs have been taken away. The second way that you get out of that, a country can get out of that, is through debt restructuring, or we'll call that a default. That means you don't pay your debts. Well, it's not possible in the United States. It's not really possible in most parts of the world for that matter. The IMF, et cetera, they never let these countries really go broke. And so austerity is not really an option. Defaulting on the debt's not really an option. The third way is redistribution of wealth. And so we talked about this. The government can't give what they haven't taken. And so the governments could just come and take more of your wealth. The problem is there's not enough of that to go around. So if the United States took every single person's money, every billionaire, trillions of dollars, it wouldn't even make a dent in the amount of debt that's owed. So they can take all the wealth they want, but it's not going to make a difference. The other problem is that once they take about more than 50%, the people are pretty unhappy. Next thing you know, revolutions happen. So that's not really a good option. And then the fourth option is this central bank printing money. The problem with that is, as we've seen, this high inflation leads to civil unrest and people aren't happy about it. So those are the typical 4 ways, but there's another way, a 5th way that we can get out of this, and that's what we're going to break down for you right now. All right, that's called financial repression. Financial repression. This is a term coined by 2 Stanford economists in 1973. They came up with this great option for the government to get out of debt, but it's not so great for you. All right, it's the likeliest choice for most governments because default or restructuring is politically unpalatable. Nobody wants those options, as we explained. It involves government in some way, shape, or form clawing back, taking back, stealing wealth from individuals. Stealing your wealth, taking it back. The wealth that you made, we're going to peel that back, claw it back. It's been associated with rapid reductions of government debt in the past. I'm going to break those down for you historical. And we can see that it's been observed in the United States. All right. So the bankers want option number 5. None of those first 4 options work. They want financial repression. In 2011, there was a paper published, and actually it was published in 2015 by the IMF, the International Monetary Fund. They put out the paper that says this specifically. As a matter of fact, the name of the paper that they published, I have it right here, is The Liquidation of Government Debt. It was issued here March 2011, but not published until 2015. And it talks about historic periods of high indebtedness. And I'm not going to read you the whole thing. You can go read this, but this is published by the IMF, showing they want financial repression. We can see, of course, everybody's favorite asset manager, BlackRock, basically said the same thing. In 2019, they put out a paper, how to deal with the next downturn, and they talked about the need of the governments to do financial repression as well. All right. Now, I know you guys gave me all those good comments on my last video. You love my history lessons. So we'll give you another one right now. Go ahead and leave me a comment if you love these history lessons. And while you're at it, hit that like button so more people see this video, and hit that subscribe button while you're at it. Okay, now let's go ahead and take a trip back through history. All right, here we are back in time. We've traveled back about 80 years into the past. Now, 80 years is a key number. If you've watched my videos, you know that I've been talking about 3 revolutionary cycles that are converging now at the same time: a 250-year political revolution cycle, an 80-year financial revolution cycle, and a 50-year technological revolution cycle. If you haven't watched those, I got a whole playlist full of videos breaking that down. Editor will go ahead and link that up here. You can go watch those. But if you notice, this is 80 years ago, at the last financial reset or the last financial revolution. 1940 is what we're talking about. At that time, the US debt to GDP was 120%. Very high, well past the 90% debt to GDP, or the Keynesian multiplier we talked about. Not quite at the 130% debt to GDP that we talked about with Hirschman Capital. But the problem is, back then, 1940, we were there at 120% debt to GDP. And what did the governments do? Well, they enacted something called yield curve control. You've probably been hearing about that quite a bit. A lot of talk about the yield curves inverting. And so the governments don't want the yield curves to invert, and so instead they want to control that. They want to peg those rates so they don't invert. Now, if you don't know what I'm talking about, you want me to dig in that in another video, leave me a comment down below. We can do that. And so they used the yield curve control, managing that yield curve, as a way to inflate away the debt. So I'll show you exactly how that works. Now, what you can see, though, is in 1940, we had 120% debt to GDP, and they were able to get that all the way down here by 1960, 1970, right here, down to about 40% debt to GDP. So it worked. It worked great for them. It didn't work so well for the people that they stole all the money from. So let me show you. Let me pull this chart up a little bit higher. And what we can see is that in this period of the 1940s, right about here, where this green circle is, we can see these gray lines is the federal deficit as a percent of GDP. And so the government was printing lots and lots of money. All right, they did that. But the problem is inflation was running really high, and they wanted to control that. As they were printing all this money, you can see this blue line right here is the increase in the monetary base. Look how much the monetary base increased during that period. So they printed all this money, but what they did, this orange line right here is the interest rates, and you can see they brought them down to 0, and they held them down for this whole period of time right there. That's the short-term interest rate. So they printed lots of money, but then they controlled the rates, and they artificially kept that down. As they did that, it brought the debt levels, as I said, from 120 down to about 40%. They had pegged the long-term rate, or the short-term rate, to 0.375, the long-term rate to about 2.5%. Now, one thing to keep in mind is that inflation was extremely volatile. So the CPI metric that we have right now, it's at 9.1. Will the next CPI print be higher? Will it be lower? Well, it could be lower, but it doesn't mean that it necessarily will be going down. Remember, it's always extremely volatile at the top, and that's exactly what happened here. So the blue line here is the CPI index, and you can see it going up and down. And you can see right here, so this is at the beginning right here, you can see how high the CPI shot up, and then you can see it plunged all the way back down again. And then it shot all the way back up, and it plunged all the way back down negative. So you can see how volatile that is, and so that's what we can expect moving forward. All right, now that I've set this situation up, I've shown you that it's just math. There's no way we grow out of this. The only 4 options we have are ones the governments will never take, and the one they're going to take is the 5th and final option, which is financial repression, of course, as the IMF stated, as good old BlackRock has stated, as we've seen them already do 80 years ago, remember, in an 80-year financial revolution cycle. So if it's going to happen again, which is my base case, what do we do about it? How do we play this financial repression? So let's take a look at that for a second. All right, now the first thing we have to understand is, going back to that first one, there were no lifeboats. The ship was sinking, but there was no way to get off. There was no way to protect yourself from that. The reason why is, before that happened in 1933, under Executive Order 6102, then President FDR, he confiscated all the money. At the time, gold was money. Gold had been money for 5,000 years. People put their gold in the banks, and the banks gave them back claims on that, paper gold certificates that could be redeemed for gold at any time they wanted. But under Act 6102, FDR seized all the gold, made it illegal for anyone to own gold, which would have been the safety net. Now you can see, here's a picture of him and all his buddies sitting around smiling and laughing, thinking about all the money they're going to steal from you. Here's a picture of the executive order that he signed. And what's important to understand about that is, again, he did steal your wealth. So at the time, they seized all the gold in the bank, but don't worry, they gave you paper gold certificates in exchange. As a matter of fact, they gave you 20 paper dollars for every 1 physical ounce you had in the bank. It's all good, right? Well, not necessarily, because right after that, they revalued gold to $35 an ounce. So that means they just took all your wealth away. And so you can see the purchasing power of the dollar, and you can see how volatile it was. And so right here is where gold was confiscated, and the purchasing power of the dollar plummeted. You can see it plummeted again right here in 1971 when they finally severed their ties to gold. So they seized the gold, which was your safety boat, and then they devalued it, so you lost even more money. And then on top of it, they used a bunch of propaganda to get people to buy the war bonds. They wanted everyone to go into the bonds. That's the financial repression. If I haven't explained this properly, financial repression is high inflation because they're printing lots of money, as I showed you in 1940. Printing lots of money, high inflation. And then the bonds pay less than the rate of inflation. So let's say that inflation, for easy numbers, is 10%. The bonds pay you 5%. You're actually losing 5%. You're losing 5% of your wealth. That's how they steal that from you. And so they need to take away the lifeboats and force you into the bonds. So you'll start to see pension funds. You'll start to see more financial analysts and financial advisors starting to push you into bonds. The governments will start to require more of these pensions to buy bonds so they can force you in that, so they can practice this financial repression, and they can steal that away through high inflation and low bond payments. Okay, so where do you go during this time? Well, you want to beware of bonds, because that's the whole plan. That's how they want to steal this wealth back from you, like they did in 1940. So you want to beware of bonds. As a matter of fact, we can see that bonds were completely destroyed. So here's a chart going back to 1940 to 1960 right here, highlighted in yellow. And what we can see is that bonds were completely destroyed. As a matter of fact, they were negative. Cash was also negative, though, because of the high inflation that we had at that time. Stocks did pretty good. So we had 1950 to 1960, stocks went up by 16%, while bonds went down by almost 2%. All right, so bonds got completely destroyed because that was the mechanism to steal wealth. The stocks did well, but we need to take a look at that, all right? Because remember, things don't always repeat, but they rhyme. So we need to take a look at that. What we can see here in this period that we're talking about highlighted in red, the S&P 500 to bond ratio was completely flat. So it looks like the index did okay, but it did pretty good. We want to look at this period right here, 1942 to 1951. During the yield curve control, the Dow Jones actually went up by over 200%. A 200% increase, which again looks pretty good. Now, it doesn't take into consideration the inflation. As I showed you, the balance sheet had completely exploded. But what I think is important to understand for today's context is that, yes, stocks did amazingly well in that last period, but the valuations were way different. So what we can see highlighted in this red section right here is the PE ratio, the price to earning ratio on stocks. And what we can see is they were at the bottom. They were extremely low. So what we can see is that the PE ratios had only ever been higher one time here back after 2008. And we saw it a little bit right here at the 2000 crash, which of course was another peak. And so we're at a very high PE ratio. They've come down, but are nowhere near where they were at that period. Now, it's important to understand this metric right here. And the reason why it's important to understand this is because there's a very good chance that Google or Facebook or Netflix or Tesla, fill in the blank with your favorite stock. There's a good chance that Amazon will be a much bigger company in the future, call it 10 years. There's a good chance they'll be still here, they'll be a bigger company, they'll have more market share, and they'll be doing more revenue than they are today. There's a good chance that happens. But the stock could be lower than it is today. And the reason why the stock could be lower, even though they're bigger, have more market share, and have more revenue, is because of this ratio or this multiplier that's being used. And so just because it's cheap today doesn't mean it's cheap. The company could do better. And so it's important to understand that the stocks did good, but look at that environment we're in. Stocks were extremely cheap today. Back then. Today, stocks are still pretty expensive on a historical basis, not even back to average. Okay, now, if we want to beat financial repression, how do we beat it, right? Remember, the government's trying to steal our wealth. They're trying to force us into positions so they can steal that wealth away. Claw it back. That's their words, not mine. All right, what we want is we want to be in a period of higher inflation, we want to be in inflation hedges. All right, what are those inflation hedges? Well, stocks certainly are, but you have to be careful of the multiples that you're paying for them. So just because, like I said, a stock price came down doesn't mean it's a good buy. Look at those multiples. That's what you really want to be paying attention to. Another place that I think is good is real estate. Now, a lot of people are expecting the real estate market to blow up, and it certainly could. Now, I don't know what your definition of a correction is versus a crash. Let's say after a 100% run up in real estate, a 20 to 25% pullback could be pretty healthy. That's a correction. 25, 30% or more, maybe a crash, you can figure that out. But what happens is, under this type of inflationary environment, and through the use of debt, using debt and inflation together, we can do really good. I have this chart right here to show you. I don't know if you'll be able to see this, it's pretty small. These are all the different types of assets, and this is the 1940 to 1960 period right here. And what we can see here is that pretty much all the assets, treasury bills were down, house prices went up. So we went up by 3% on house prices. So let me explain to you how this works with debt. If you buy a $100,000 house and it goes up by 3%, how much money did you make? If you answered $3,000, you would probably be wrong. Now, you would be right if you paid cash for the house, but 94% of home purchases are done with debt. So let's say that you had put 5% down on the house, or $5,000, and it went up by 3%. You put $5,000 down, you made $3,000 back. Now you've made like a 75% return on your money. To see how that works. So using debt and real estate, it's interesting, can work really well. Gold went down during that period because of the negative real rates. When rates are negative, gold could be a problem. Like I said, stocks did really well right here, but you have to be aware of those PE ratios. Back to real estate, for example, we can see from 1940 right here to 1960, we can see the price did pretty well. Now, does that mean that will repeat? Well, if we go into a period of financial repression where they keep rates really high because of the central bank balance sheet expansion, then real estate could continue to do well. Now, over the next 6 to 8 months, anything can happen. Be prepared for anything, but that's a good place to be. Another thing would be gold, silver, and Bitcoin. The reason why I like those is because they're all bearer instruments. Remember, what they did is they took away the lifeboat. The lifeboat would have been to have that gold and put it in my house, but they seized the gold. So we had nowhere to go. So we can get our money out, we can get our gold, silver, our Bitcoin, we can take custody of that on our own, and we can hold it. That way they can't seize it and inflate it away. Those are another assets that I like. Now, one little tidbit just for this, I know a lot of you guys may not like Bitcoin, but I think it's pretty interesting to understand this, is that Bitcoin was actually made for this. It's very easy to take custody, so I can take it, I can just download it. I don't have to build a safe in my house to guard the gold. I can just download it and encrypt it on a drive. I can transfer it peer-to-peer. It's very difficult to transfer gold across space, but of course Bitcoin can be transferred peer-to-peer without anybody knowing about it and any over distance. But it was also created specifically for this threat. Why do I say that? Well, Satoshi Nakamoto, his birthday was listed as April 5th, 1975. What's important about those dates? Well, April 5th, 1933 is the date that FDR seized your gold. April 5th, 1975. What about that date? Well, that's the date that we were able to own gold again. They reversed the law and made Americans able to own gold. It was specifically made for this date and time, and I believe we're going back into a period of financial repression. The central bankers only have this 1/5 option. The IMF has called for it, and this is some historical precedents to show you what could happen. Now, there's a lot more to it. I know this is a high-level concept, which is why, like I said, I'm having probably about a 1 hour deep dive where I have a bunch of charts, graphs. I'm going to show you how I'm going to be navigating this, what I'm looking at, so I know what I'm doing, how I'm buying, what I'm selling, etc. So there's a link down below if you want to come hang out with me, do live Q&A. I do them about once every other month or so. Hopefully make it. If not, no big deal. Give me a thumbs up on this video if you like it. If you don't, you can give me a thumbs down. That's okay, but at least leave me a comment and tell me why. That's what I got for you today. All right, to your success. I'm out. Since you've stayed to the end, I know you like this video, which means you're probably gonna really like this video right here and this video right here.